Just a few days ago, global financial markets got hit by a perfect storm. The Nasdaq plunged 4% in a single day, and we're not talking about some niche sector here. This is the beating heart of US tech. The NSI Pacific markets opened with a gut punch. So Korea actually hit its circuit breaker. If real needs asking the same question, is this the start of another global financial crisis? In the next 50 minutes, we're breaking down exactly where this storm came from, how bad it gets, and the most dangerous turning point dead ahead. First, let's talk about how severe this actually was. Real end to the 5th of June, the US drops its May non-farm payroll numbers nearly double what anyone expected. Right, it cut expectations, gotten just like that. The market actually started asking should the Fed be hiking instead. 30 same session, the Nasdaq cratered 4.18%. But here, as the SI NGT didn't stop there. Over the weekend, Middle East tensions flared, oil spiked. Monday morning, SA Pacific markets took a double hit. So Korea as Korea's briefly crashed 8%, trading halted. Japan C and Taiwan EC semiconductor names sold off across the board. SI as is your routine pullback. SI as is cross-market, cross-asset, cross-border panic feeding on itself. Now, a lot of people will tell you, look, US stocks drop sometimes, it's just a correction. But this time is different. Sorry, reasons why. First, the complete reversal of rate cut expectations. For 6 months, everyone was on the same boat, betting the Fed would cut. The 5th of June hits, and suddenly the captain SCRM SOC case ahead, hard right. Over NIJIT, the conversation flipped from how many cuts this year to are we actually looking at hikes. That is a 180-degree turn, and if you reload it up on growth stocks, tech names, you don't exactly have time to pivot. Second, geopolitical conflict throwing gasoline on the fire. RD tech stocks were already walking on glass. Poyo IT2 geopolitical conflict poured fuel on the fire at the worst possible moment. NK about IT his stock market was already stretched tight like a string on the verge of snapping from rate hike panic. Suddenly, the Iran-Israel conflict escalates and oil prices shoot straight up. Oil goes up, inflation gets even harder to tame. Inflat iron stays hot, Treasury yields have no choice but to rise. YAE LDS rise, and tech still 6 the most rate-sensitive sector. Tech is the first hit. Where do you call that? ESATLY what everyone feared. POE NT3, and this is the brutal truth that edge stocks were a house of cards all along. Look at semiconductors, how much have they gained since the start of the year? Nearly doubled. But how much of that was real earnings growth, and how much was just money pouring in and piling up? Post-80 were extremely crowded. If Riona convinced themselves the AI revolution would keep climbing forever, then Broadcom steps up and says it first. We missed expectations. Just that one sentence, like the first domino falling. Instead, UTIO investors smell trouble and hit the mass sell button immediately. CRT was anti-selling, CRT was fleeing. By the time you, the retail investor, open your app and react, all you see is wreckage too late. ALRHT, we covered why it fell. Now let's look at who's bleeding. You might think the storm center is America, that America's hurting the most. WNG, the ones taking the deepest wounds are the front row spectators. In Asia Pacific, why back us is so Korea, Japan, Taiwan, the economies live and die on semiconductor exports. US tech falls, they fall harder. So Korea triggered a circuit breaker. It's not a technical glitch, that is a liquidity crisis. For AGN capital as logic is simple, the dollar as rising, Treasury yields are rising. Why would LDNTI pull money back to America for risk-free returns? So first thing they dumped the Korean won, dumped the yen, dumped Korean stocks. SIA Pacific became the first target of capital flight. By contrast, A shares and Hongji stocks got dragged down too, but the drop was noticeably smaller. Not because they re-immune, but because they never rallied much to begin with. Value ATIs were already at rock bottom. The re was NT much room left to fall. But that doesn't mean we can relax. STIL the ups and downs of the stock market. To the real heavy hitters, that's just ripples. The real battlefield is the bond market. Look at this stat as EUS 2-year Treasury yield is now clearly above the Fed's policy rate. Chara NSL ATI on the market is pre-EMT hiking rates for the Fed. And the next critical turning point is the 10th of June through ASME CPI data drops. If inflation breaks above 4%, I'm telling you Treasury yields will climb another step. At that point, global risk as ETSTO case, Bitcoin income, mod ETSW will face a repricing. Size is about how much they fall. It's about recalculating what they actually worth. The re as one more risk hiding. Where most people aren't looking, GG and IPOs are lining up to drain market liquidity. SpaceX, OpenAI, these names sound exciting, right? XATING sure, but don't forget the why pulling water out of the market. There is only so much money to go around. when massive capital gets locked up subscribing to new shares. What else left propping up the sky-high valuations of legacy tech like Nvidia, Tesla, Microsoft? SaaS might not trigger a crisis directly, but it's like a slow blood EDM Aki NG an already fragile market, even worse. Rig HT now, the global financial market is like an extremely sensitive patient just out of the ICU. Temper a two-ray swinging up and down, blood pressure rising and falling. Any small piece of news could send them straight back into the emergency room. Over the next 15 days, there are 3 key variables, each one fully capable of changing the direction. Let me highlight them for you, one by one. First up, Tuesday, the 10th of June, CPI data release day. At 8:30 that morning, traders around the world will be clutching their coffee, eyes glued to their screens. If inflation breaks 4%, the market will immediately switch into tightening mode. Who gets hurt the most? Grow W stocks. So tech companies not yet profitable, still living off their stories, they'll be the first to be dumped. On the flip side, if the data is mild, say 3.6% or 3.7%, the market will breathe a sigh of relief. But make no mistake, that's just a breather, not a reversal. Back Aus E right behind it comes the second hurdle sec on the stop, the 16th of June to 17th, the Fed policy meeting. SaaS is no ordinary meeting. SaaS is the first appearance of the new Cha IR Warshaj. If real Nay is guessing, what is this person really like? If he comes across as very hawkish, clearly hinting at more rate hikes to come, global stocks will continue to fall. Don't hold out false hope. If he seems too weak, saying inflation is nothing to worry about, the market will become even more fearful. Fear RFUL of what? Fear RFUL that he can't keep inflation under control. What the market most wants to see is a balanced stance. Acknowledge that inflation is stubborn, but don't rush into rate hikes. SaaS kind of tightrope walking communication is the hardest to pull off. One wrong word and it could mean a swing of several hundred points. RD stop, and the most unpredictable one, geopolitics. Iran and Israel, when will this powder keg explode again? No one knows. But if tensions escalate, oil prices will jump. When oil prices jump, inflation becomes even harder to bring down. When inflation won't come down, interest rates have to stay high. When interest rates stay high, every asset price gets discounted. SaaS is an interconnected chain, and the most vulnerable link is the valuation of tech stocks. The SA3 nodes are like 3 sharp curves in the road. CPI data determines inflation's short-term direction. The Fed meeting sets policy's long-term tone. Geopolitics drives the most extreme tail risk. Make either wrong turn at anyone, and you could crash. We covered the big picture. I know what you're asking. What should I do? Sell L by the dip. I don't recommend stocks or give wealth passwords, but here are 3 practical frameworks. See which fits you. Rule E1 most important: don't rush to buy the dip. One thing G bargains is human nature, but we re in the zone of highest uncertainty. CPI is T out yet. Fed has NT signaled. Mid-dollar EST could change any moment. Is that bottom really the bottom or just a mid-slope? BEF or the Fed's decision, deep buying is catching a falling knife. No matter how fast you are, you can still get skewered. Rule E2 switch from offense to defense. Where T's defense. HIG H dividend stocks, steady profits, yearly payouts, won't rise much, won't fall deep. Bank as higher rates widen their interest margins, profits improve. NERG oil price hikes directly benefit energy companies. Mana NWHL unprofitable tech roll stocks burning cash. The next months will be very painful. Not because they re bad companies, the water temperature changed. In a high rate sea, it's no time to go skinny dipping. Real E3 don't overlook shares and Hongji stocks. Man why say a shares underperform, but when global markets fall, the ones that fall list are winners. A shares and HK valuations are already at global bottom. Plalo's domestic policy is easing rate cuts, liquidity, stimulus. In global turmoil, low valuation plus policy support equals resilience, not saying they'll surge, but when a drop comes, it won't hurt as much. Let's wrap this up. SaaS is the end of the world. So far, not 2008, no banks collapsing, no subprime chain reaction. But it is a turning point in pricing logic. Past 6 months, the market lived in a rate cut fantasy, believing Fed would cut anytime, tech stocks would rise forever. Stay RTING today, face reality, inflation is T docile, rate is T low, and volatility is T small. The storm is not over yet, the volatility is not over yet. But as long as you read the wind direction clearly, you won't be blown away.